good afternoon. Welcome to this CNBC Africa special broadcast, of course, on the South African Reserve Bank's first Monetary Policy Committee meeting for the year, where consensus forecast is that the MPC is expected to keep interest rates in South Africa on hold. That's the repo rate at 8.25%, and if they do, it will be the third time in a row that the SARB does hold rates. So what have we seen ahead of this decision? We have seen inflation coming down. In fact, the latest print on the producer front showing that producer price inflation coming in at 4% in the month of December versus expectations of 4.3%. We also saw a similar kind of chord being struck by the consumer price inflation, which was released yesterday, which also came in a little bit better than expected at 5.1% versus expectations of 5.2% in December. We have seen prices increasing, or rather prices declining in terms of what the food basket is doing and also what the fuel basket is doing, and that is helping to alleviate pressures on the headline front. But it will all be about what the SARB has to say in just a moment in time. In fact, in just a short while, we should see the South African Reserve Bank governor stepping to the podium. Perhaps we give you a report on what the rand is doing right now ahead of that key decision, where we have seen quite a bit of moves on the currency front, but I'm told that the governor is there and he's about to begin. So let's take you to Pretoria, the capital here in South Africa, and hear what he has to say.
As the new year begins, global economic conditions remain mixed and the outlook uncertain. While headline inflation continues to ease in much of the world, core inflation remains sticky and high. Both advanced and emerging economies are likely to see modest economic growth this year, despite better than expected outcomes in 2023. In most countries, reaching inflation targets, reducing fiscal deficits, and containing or lowering debt levels will stay as key policy priorities. Financing conditions are expected to remain tight. The longer-term economic outlook is also uncertain, as geopolitical tensions and climate change threaten supply chains, output, and prices. The uncertainty, alongside high interest rates and debt, will dampen investor appetite and capital flows, resulting in volatile financial markets and asset prices. Taking these and other factors into account, the SARB's forecast expects relatively weak global growth of 2.6% in 2024. The domestic GDP outcome for the third quarter of 2023 was weaker than expected at a negative 0.2%. We expect the fourth quarter to show some improvement, with output expanding by 0.4%. The weaker performance of the economy in the latter half of 2023 is in line with the bank's forecast. The operation of ports and rail has become a serious constraint, and alongside electricity shortages, contributed to weak output growth and higher costs last year. These constraints are expected to persist, severely limiting potential growth of the economy. While we expect electricity supply to increase gradually over the longer term, its contribution to short and medium-term growth has not been revised after the upward adjustment made at the time of the November meeting. On the demand side, household consumption and investment have eased significantly, while government spending has been sustained. As we highlighted throughout last year, commodity export prices have receded sharply from the highs reached in 2022, reducing the contribution of foreign demand to growth. For 2023 as a whole, GDP growth is revised down slightly to 0.6% from the November figure of 0.8%. Our GDP growth forecast for 2024 and 2025 is unchanged from the previous meeting at 1.2% and 1.3% respectively. At present, we assess the risks to the medium-term domestic growth outlook to be balanced. With the weaker GDP outcome in 2023, our current growth forecast leaves the output gap marginally negative and at zero in the outer years of the forecast. Compared to many other emerging and advanced economies, the rise in South Africa's headline inflation rate was more gradual and peaked lower. However, the return to target has been slow. The inflation rate remains sensitive to changes to both global and domestic supply and demand. Due to global factors, oil prices remain generally high at around $82 per barrel. We expect them, however, to be somewhat lower this year and next compared to the November forecast. Commodity export prices fell sharply last year by about 27% and are expected to fall by a further 12% this year. As a result, and despite modest economic growth, South Africa's external financing needs will increase as the current account deficit expands. We expect a deficit of 1.4% of GDP in 2023, rising to 2.8% of GDP in 2024, and 3.6% of GDP in 2025. The uncertainties of the global environment and various South Africa-specific factors, including sluggish growth and dependence on commodity export prices, continue to weigh on the value of the currency. The rand depreciated over the past year by about 11% against the US dollar, making it one of the worst performing emerging market currencies. The implied starting point for the rand forecast is 18.65 to the US dollar compared to 18.69 at the time of the previous meeting. Fuel price inflation is expected to be low, averaging below 1% in 2024. Food price inflation is revised slightly higher for 2024 to 5.7%, but remains broadly unchanged over the forecast period. Core inflation was 4.9% in 2023. The core inflation forecast for 2024 and 2025 is little changed at 4.6% and 4.5% in 2026. Services inflation in 2023 was 4.2%. The forecast for 2024 services price inflation remains unchanged at 4.8%. Core goods inflation was 6.1% in 2023 and is forecast to ease to 4.5% this year. While average salaries grew less than expected in the latter half of 2023, they are forecast to hit long-term averages for the rest of the forecast period. Headline inflation was 6% in 2023. With few significant changes to the forecast for underlying components, headline inflation is expected to ease to 5% for 2024, to 4.6% in 2025, and to 4.5% in 2026. While our baseline inflation forecast is of continued gradual moderation in global and domestic inflation, the risks to the outlook are still assessed to the upside. better than expected global growth last year, and ongoing geopolitical tensions this year serve to keep oil markets tight. Despite some improvements, advanced economies continue to experience strong wage growth and elevated core inflation. South Africa's imported goods inflation increased strongly last year, and despite some better recent outcomes, remains sensitive to currency weakness. Recent increases in egg and potato prices remind us that domestic food price inflation remains unpredictable and high. Electricity prices and logistics constraints continue to present clear inflation risks. With fuel and food price inflation remaining volatile, risk still attaches to the forecast for average salaries. Housing and services prices, more broadly and in contrast, may continue to provide some downside relief to the inflation risk profile. Sticky inflation in G3 economies implies that their average policy rates will remain elevated at about 4.3% in 2024 compared to 1.1% average seen in 2022. These tighter global financial conditions raise the risk profile of economies needing foreign capital. South Africa's long-term cost of borrowing is expected to remain, and despite moderating inflation, long-term bond yields currently trade around 12%. The rise in inflation in 2022 generally resulted in higher inflation expectations across markets, businesses, and households in 2023. Medium and longer-term market expectations for inflation remain elevated. The December survey of the Bureau for Economic Research shows average inflation expectations increased to 5.9% for 2024. Achieving permanently lower inflation and interest rates requires inflation expectations to be closely anchored to the midpoint of the target band. Against this backdrop, the MPC decided to keep the repurchase rate at its current level of 8.25% per year. The decision was unanimous. At the current repurchase rate level, policy is restrictive, consistent with the inflation outlook and the need to address rising inflation expectations. Serious upside risks to the inflation trajectory from global and domestic sources are evident, and as noted earlier, the economic outlook is highly uncertain. The inflation and repo rate projections from the updated QPM remain a broad policy guide, changing from meeting to meeting in response to new data. Future committee decisions will be data dependent and sensitive to the balance of risks to the outlook. Guiding inflation expectations back towards the midpoint of the target band will improve the economic outlook and reduce borrowing costs. Since early 2020, the committee has recommended additional means of strengthening economic conditions, including achieving a prudent public debt level, increasing the supply of energy, keeping administered price inflation low, and real wage growth in line with productivity gains. Such steps would also strengthen monetary policy effectiveness and its transmission to the broader economy. This concludes our statement, and at this point, I would invite you to pose questions, and I will address those questions or refer them to the members of the committee.
Afternoon, Governor and Deputy Governors. It's Kopano Gumbi from Reuters. A few questions for everyone. First, do you believe that inflation will still be the dominant theme or trend for this year, and that higher for longer remains the message that the Reserve Bank is trying to communicate to the market? This is almost redundant, but I have to ask it anyway. Is the cutting cycle on the horizon yet, or are the upside risks you've mentioned outweighing the possibility of a cutting cycle in this first half or second half of the year? And then thirdly, Stats SA data up to Q3 at least shows us that the economy has been hovering around 0% growth this last year. Households are in a recession, to quote Stats SA, following 2 consecutive quarters of negative growth from the consumption expenditure side. Disposable incomes have also contracted a bit. Inflation is now steadily falling, and as you say, your output gap is now negative. So given those scenarios, why not cut rates? Thank you.
Kopano, you seem to be the press conference today.
Greetings, it's Balesa Mufukeng from CNBC Africa. Governor, given all the risk factors that you outlined, in your view, what factors would you say are most likely to count the most in determining not only the depth, but also the pace of the rate cutting cycle? Thanks.
Okay, I will link your question to Kopano's second question, which asked, is the cutting cycle on the horizon yet? And you asked, what are the factors that will influence the rate cutting cycle? We are an inflation targeter, a flexible one. Inflation rose and rose above our target band. It started to decline, but it was very slow. Then it eventually declined to 5.4. Then it declined all the way to 4.7. Then it picked up from 4.7 to 4.8, back to 5.4, and rose to 5.9. It had since receded from the 5.9 to the 5.5, and the most recent figure of 5.1. I'm quoting these numbers to say to you, there isn't a discernible trend that shows that inflation is declining towards our target. And so, for as long as there isn't any sustained decline of inflation towards our target, and more importantly, that inflation stays there in a sustained manner, don't expect us to recalibrate policy. And you wanted to know about these other factors. All of those factors, they just tell us about the risk. Focus on what is the anchor of policy. The anchor of policy is inflation. And it's only when we are convinced that inflation has declined to target and is sustained there that it would become necessary to recalibrate policy. And so Kopano says that the household sector is weak, personal income taxes, personal disposable income is weak, the output gap is negative. And I agree with you. Household consumption is weak, personal disposable income is weak, and all of those things we are talking to them in real terms, which means adjusted for inflation. So inflation is eating people's disposable income. and thus constraining their ability to spend. And if people are to have the income that they would spend in the future, you have got to be able to, you have got to rein in inflation. Failure to rein in inflation, you are eroding the purchasing power of all of those. The output gap, if you look at the statement, we said is marginally negative. Really, it's negative 0.1. It's a rounding off error. For all intents and purposes, over the forecast period, the output gap does not exist. And when the output gap does not exist, it tells us that there aren't either pressures that are demand pressures that are putting the inflation up or pushing it down. So it's there. But bear in mind, and people say this thing, the output gap is a non-observed variable. It is an imputed variable. We'll calculate that from the potential growth compared to the actual growth. That is how we arrive at the output gap. You ask the question, is inflation a dominant factor this year and thus higher for longer? Well, we could put it differently. What is foremost in the minds of the public? It's been the high cost of living. And across the world, you had seen that inflation rose and thus increased the cost of living. And in a survey that was run by one of the major global survey companies, which also covered South Africa, by the way, found a public that is highly intolerant of the high cost of living and of inflation. And that is the story that you find even in the advanced economies today. And hence you will find that even in advanced economies, the talk is the rates will remain high for longer until you are able to convince the public by demonstrating that inflation has been reined in towards the target and is actually sustained there for a period of time. And that is what will then lead to central banks revisiting their things. So sometimes people ask, when will this thing be? And your question is the cutting cycle on the horizon? And it's very cleverly put, because you see horizon, you'll be asking, is it 1 quarter, 2 quarters, 3 quarters? And the answer is a very straightforward one. The cutting has got nothing to do with the time. It has to do with the state. So we are not time dependent, we are state dependent. And so what this actually means is we will be watching the key variables being the inflation outlook, the growth outlook, the risks attendant to that, the likelihood of those risks materializing or not materializing, and if we believe the risks are materializing, we will recalibrate policy appropriately. You have a mic.
Good afternoon. I wanted to wait because it's not related to today, but 2 questions to the
Your
SARB.
name?
It's Dogozo Kumalo from Newsroom Africa. So 2 questions. One, just the response to ANC in KZN saying that they will march to the Reserve Bank, obviously in relation to high interest rates, the inflation versus high interest rates. And then South Africans were waiting for this announcement, West Bank being a big story around the overcharging of interest rates. Does the Reserve Bank have anything to say in that regard? I know Financial Investigator was planning to write to the SARB on that issue. And then if perhaps Mr. David Fawkes could just introduce himself to the nation, please. Thank you.
I introduced him.
Well, a little bit more in-depth from him. Thank you.
I introduced him, and we will circulate his bio so that you know who he is. Okay. Yes, ma'am.
It's Monique for Bloomberg. I wanted to know, Did all 5 MPC members vote in today's decision for it to be on hold, or was it just 4?
Come again?
Was the decision made by 5 MPC members today, or was it 4?
Okay.
Good afternoon, Governor and the panel members. My name is Ntando Tsukwana from Bloomberg News. My question is around the tensions in the Middle East, as well as the tensions in the Red Sea region, and whether how concerned you are about those tensions that have triggered supply chain constraints, how worried you are in terms of them interrupting your efforts in slowing down inflation, and is that in part helping to keep you hesitant about relaxing monetary policy?
We can take another one. Anybody online?
You've responded, Governor, to the questions that we have online.
Okay, thank you. Ntokozo, you're right. I will deal with your questions once we are done with the business of the MPC. Monique, so it is said, David Fox joined the MPC. He attended his first MPC this week. So he was a full participant this week. He was appointed with effect from the 11th of January. And so there were 5 people. So when we say it was unanimous, it was not unanimous of 4 minus excluding the 1. It was the unanimous of 5. Okay. And Ntokozo, very important question you're raising about the tensions, you said, in the Middle East. And you would have heard we talked about geopolitical tensions, and it was not just the Middle East, it was also Russia-Ukraine situation. But the tensions in the Middle East and the impact on the global supply chains, the figures might have changed, but the last time I had checked, for the period of the first 2 weeks of January, something around that, last year there were just over 200 vessels that were going through the Red Sea. For the same period this year, there were just over 100. So that tells you that either the shipping lines are using alternative routes, or they had decided to reduce because of either increased costs of security and so forth. And if they cannot use that, the alternative going to Europe is to actually go round the Cape, which I suppose was exactly the reason why the Portuguese explorers decided to find the route around the Cape. So the problems in the Red Sea are centuries old, which is what led Portuguese explorers to find a route around the Cape. No doubt, if they affect the global supply chains, as we had seen from the initial figures, those costs might have to be passed. And if they are passed on to the producers will eventually pass them to the consumers, and you'll expect that inflation would actually be going up. But that is the tensions there. There is another problem which has to do with the Panama Canal, which has got nothing to do with a war. It just had to do with the water levels in the Panama Canal, which has also raised the constraints with respect to shipping that goes through that canal. So when we referred to...
Well, that's the governor just speaking about some of the tensions regarding the supply chain that could potentially impact inflation if the situations there are not contained in the Middle East, as well as the insurgency that we are seeing around the Red Sea route, but not saying anything new in terms of what was expected for the interest rate decision. This time around being no change. Repo rate remaining at 8.25%, I believe prime at 11.75% this time. Good for savers, not so good for debtors.